Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 226th VideoCast podcast for the week ending February 15th, 2024. Very excited to, we'll do a few quick family updates. First and foremost, they had another water polo game in Brooklyn. So when in Rome, we went to, obviously, Peter Luger's, had a blast there. Sat in a different room this time, and that was just a wonderful experience. And then I want to show you a couple of these goals, and then we'll get right down to business here. Here we go, Mimi. Fake out, boom. That was that. And then we got a second one with Annabelle. Oh no, that's Mimi again. All right. As you can tell, I'm the... There's Annabelle. All right, so that was that. That was a lot of fun. As you can tell from my voice in the background, I'm, the most annoying parent of all time in the stands. But anyway, they love it. And let's move on to media. Want to thank Fitria Anggrani and Andy Salini for having me on CNBC Indonesia on Tuesday morning at the lovely hour of 4:20 a.m., which is 4:20 p.m., their closing bell in Jakarta. And we went into some inflation. Got that wrong, by the way, which we're going to cover why and actually break it down. And the market kind of figured out what we were seeing the day after, which is good. Want to thank Meta Singh for including me in her article on Reuters today. Want to thank Samritha Arunsalam for including me in her article on Reuters yesterday. And want to thank Samritha A for including me in her article on Reuters 2 days ago. Here's from Ryan Dietrich over on Twitter. He's from Carson Group talking about small caps breaking out. That would upset a lot of people. We agree. We're positioned for that. And we did some of this analysis in our article of the week, small caps to S&P 500. And only we went back to the early 2000s. So you can see it hasn't been that low since then. He's doing, I guess this is like a huge bull flag or whatever they call it in technical terminology. And it's breaking out from there. I did this shorter term chart, which is about a year. And you can see here, it's up against resistance and looks like it wants to break out. This is the lagging index, which could play catch up where a lot of alpha could be captured this week. We're going to get one important small cap after the bell. I don't focus exclusively on quarterly earnings. That's less important to me, but I'll be very eager to see Cooper Standard and then more importantly, the earnings call tomorrow morning to see if they're on track with getting free cash flow positive and driving the business forward. Looking at the OEMs, it should bode well for their overall volumes, and that would be a good thing. Seth Golden over on Twitter forwarding information from Fundstrat. Margin debt needs to surge to mark a near-term top. Recent peak was $710 billion. Too much dry powder on the sidelines, thus we think by the dips. Yeah, so we're kind of agnostic here. We said last week that we didn't want to get too cute because everyone's looking for this late February pullback due to the seasonally weak period. The counterpoint to that is we're just breaking out after 2 years of no gains. So we did put a tactical short on across portfolios with 1% of equity. We'll be very happy to lose that 1% because that means the portfolio will be up another 5 or 6%. But if we don't lose that 1%, and that actually has a 5x expected value, that 1% of equity becomes 5% on a pullback of 7% or 5x in a couple of months. The benefit of that versus exclusively riding it out, which we're very comfortable to do as well, but just seeing some of the biggest names in the business flip bullish or get fired because they've been bearish for the whole 40% ride up off the 2022 lows. there's not euphoria yet, so I do think we are going to push a little higher, but I wanted to have a hedge because if we do get that 5x, number one, it'll dampen short-term volatility, which is fine, but it gives us 5% of free capital of overall equity value that we can then go long once we hit our target of 5 to 8% pullback or whatever that is, which could be 3 to 4x on the way up if we do long dated spreads into the end of the year. So then you turn a correction, which would have been short-term volatility of maybe 8 or 10%, and then you just ride it back and you finish out the year strong, to a possible alpha add if it goes according to plan, which could really care less about market timing, but it could matter because we could wind up adding an extra 10 or 15% of alpha on top of what we expect will be an extraordinary year. So by the way, want to thank all the people that came in on the small account side, Craig, and there were a few others that wanted to remain anonymous. Congratulations on getting in. We're closed out for the small accounts. If you're a larger account, 5 million or 10 million, we're always open and we'll offer bespoke services, but the small accounts we try to get in all at once in a period of 1 or 2 weeks. Sometimes it takes a little longer with the approvals at Interactive Brokers, but that's all now done. We may reopen for the small accounts again sometime in Q2, but for now it's big accounts only for the next couple of months. So that's that. Moving along, Ryan also shows here the average. Ryan Dietrich also shows the average for the second half in a since 1950 is a week to two period. The issue I have with this, my guess is that everyone gets short into February. We wind up rallying into the end of February, and then when everyone gives up on their shorts, maybe sometime in March when people are expecting strength, then we finally get the correction. But at least we've got a 2-month tactical hedge. We hope we lose the 1%, but if we don't, it could add some meaningful alpha on top of it, which I think is the right way to be positioned right now. Now, a good start could mean the bull continues. Dietrich does some quantitative work here. 28 other years that were up 5% year to date at some point during February. The final 10 months, higher 25 times and up another 13.3% on average for the full year, higher 26 out of 28 times and up 21.3% on average. We're not looking for that high for the year, but we'll take it. That's for sure for the overall indices, but it just shows that strength begets strength. And I think there's still a lot of skepticism out there and a lot of fear out there. You saw it just on the one little inflation print, which after people actually looked under the surface, realized was seasonal adjustment BS. And then the market rectified itself. Atlanta GDP now is looking at plus 2.9% GDP for the first quarter. So that's good. Here's our quote of the week from Peter Lynch. When stocks are attractive, you buy them. Sure, they can go lower. I've bought stocks at $12 that went to $2, but then later they went to $30. You just don't know when you can find the bottom, which is Peter Lynch, which, by the way, that's really interesting because that's the story of Range Resources. And when it did go to $2, we actually brought our basis down. It went to 186. We brought our basis down to 410. And you know where it is now. And we think it's probably halfway towards intrinsic value and still got time to go. Daryl Bracken, the CEO of VF Corp, which we covered in detail last week. That's a turnaround play for us. You should definitely check that out if you missed last week's podcast. That was one of the best ever, by the way. He bought $1 million of stock. This was a check written out of his own pocket. This wasn't a transfer to a trust for taxes or any of that stuff. So that was positive. And then fourth year of a new presidential trend, see the most of the gains later in the year. So you get through February and early March, and then you kind of roll over into late March, early April. And that's also from Ryan over at Carson. And then our article of the week is Goolsby saves the day, stock market and sentiment results. I never thought I would utter the 4 words from this title, but as the saying goes, if you live long enough. So kudos to Austin Goolsby. president of the Chicago Fed. We came into the CPI report with expectations of a beat, inflation coming in lower than expected. Our view was predicated on a big step up in non-seasonally adjusted CPI index basis from December 2022, when it was at 296.80, to January 2023, when it was at 299.17. That's a big percentage jump in that index. So we thought with the baseline higher and the average month on month being 2.3, we would see a nice drop and get below 3%. That didn't happen. Energy and used cars dropped as anticipated, but food and shelter remained stubborn. Or did it? The question on owner's equivalent rent and how it's measured by the Bureau of Labor is completely antiquated. And we're going to show you some alternative measures that will ultimately work through. They work through on a lagged basis and have been, but not this month with the seasonal adjustment. So you can see what went down, what went up. Here are 5 different rent indexes: NTR, CPI rent, OER, Zori, apartment list. Zori is Zillow. And you can just see they're all absolutely 100% collapsing. The average, but on the Bureau of Labor, it's 12-month lag before it's reflected in the numbers. The average monthly price change of the last 12 months unadjusted was 23 basis points. If this persists through March, we could see a headline below 2.5. Now, while this did not prove to play out as anticipated this month, there were a few reasons why, which the market ultimately recalibrated to understand on Wednesday. First and foremost, you had this article by Aaron Back over at the Wall Street Journal, and he talks about the market being lower that day. Some perspective is needed. January's figure was still down from December's 3.4% pace and the slowest reading since June. And yes, the core inflation rate, stripping out food and energy, at 3.9 in January was unchanged from December. But 1 month which core inflation failed to slow hardly seems cause for panic. Just 6 months earlier, in July 2023, core inflation was running at 4.7%. Goods inflation continues to be negative as prices fall for things such as apparel and used cars, partly because of the unwinding of the pandemic shortages. Digging deeper, though, there were some signs that January's acceleration in services inflation was, quote, an aberration, more noise than signal. Most notably, shelter costs accelerated to a 0.6% rise from the prior month, compared with December's 0.4% rise. In a note, research firm Capital Economics called this jump, quote, suspicious looking, given that, quote, alternative measures of newly signed rents have been stagnating. We still expect to see more disinflation in these CPI measures based on existing rents soon, they added. And then another group, BNP Paribas, said that owner's equivalent rents, quote, show a sawtooth pattern of ups and downs recently. The bottom line is that if newly signed leases keep moderating, that will eventually feed through to slower inflation readings in the Labor Department data. The Fed's preferred inflation measure put out by the Commerce Department places a smaller weight on housing costs. That's the PCE inflation. And then finally, cooling and inflation. The overall outlook on the economy of surprising resilience and growth in jobs paired with cooling inflation remains unchanged. This is hardly a backdrop that should make investors hit the panic button. Then there was a second thing that happened. The Chicago Reserve Bank president, Austin Goolsbee, came out with this dovish take and clarification for markets. The next morning at CFR, he says inflation can be a bit higher, still on path to 2%. And he's also said inflation goal is based on PCE, not CPI, which is much lower, which we've covered many times in this podcast. The Federal Reserve Bank of Chicago President Austin Goolsbee said slightly higher inflation data for a few months would still be consistent with a path back to the central bank's 2% goal. Quote, rate cuts should be tied to confidence in being on a path toward the target. Quote, more data like we have seen in the past 6 months would indicate that path, but that's probably too stringent. Even if inflation comes in a bit higher for a few months, as many forecasts suggest, it would still be consistent with our path back to target, he said. He emphasized it's important not to judge the inflation trend from 1 month's number, and that the Fed's 2% target is based on the personal consumption's expenditures price index, not CPI. He noted that the two metrics can differ somewhat significantly. Quote, I don't support waiting until inflation on a 12-month basis has already achieved 2% to begin cutting rates, said Goolsbee, and that the central bank's current policy stance is quite restrictive. Goolsbee underscored the importance of productivity growth for the economy. Quote, if productivity continues growing at faster than trend, it will definitely change our thinking about the economy overall, but policy specifically, he said during the event. Quote, there's nothing more important than the productivity growth rate. He also noted how inflation expectations have remained in check, which he sees as evidence of the Fed's credibility. Quote, the Federal Reserve promised to get inflation back down to target, and it backed it up its words by increasing the federal funds rate by over 500 basis points, and the markets believed the Fed. Now, economic projections from December, which stated, so core inflation 12-month change was 3.88, which was the lowest of this cycle and the 10th consecutive decline. Headline was 3.09%, the lowest of the last 7 months. As Goolsbee so eloquently stated at his CFR appearance on Wednesday morning, quote, don't get flipped out over yesterday. As I've emphasized every week in the podcast VideoCast, real rates, Fed funds rates minus inflation, are excessively restrictive. Goolsbee called real rates, quote, very high in his speech. He also acknowledged that if this situation persists, Fed's restrictive posture, the current, quote, problem of inflation can quickly pivot into a, quote, serious problem of unemployment. I've gone further to state deflation is a greater risk than inflation if this level of restriction persists. When it turns, it can turn on a dime. It is comforting to see there is a member fully cognizant and vocal of this risk and publicly holding the FOMC accountable if they miss it or mess it up. For clarification, he brought up the FOMC summary of economic projections from December, which stated that they believed inflation would be at 2.4% in 2024 and they would cut 3 times. He then was explicit that their favored measure, PCE inflation, was already lower than that target of 2.4%, both on a 3 and 6 month annualized rate. Uber dovish commentary. To close it out and put market participants at ease, Goolsbee emphasized the importance of productivity gains we are now seeing by stating that, quote, nothing is more important. Furthermore, quote, it will definitely change the way we think about the economy. In other words, when you have productivity growth, wages can rise to the level of prices yielding above trend growth while simultaneously low inflation. Quote, I don't support waiting until inflation on a 12-month basis has already achieved 2% to begin to cut rates, he said. And with that, markets bounced off the danger zone yet again. So you've seen it bounce now 5 times off of this short-term uptrend line for all the technicians out there. Same with the S&P 500. Sentiment and positioning. This Tuesday, Bank of America published its monthly fund manager survey. I posted a summary here. Thanks to my buddy over there who gets me the data. Thank you so much. There were 3 key points. Number 1, fund managers are still 0.1% standard deviation below their long-term average allocation to equities. So while they are building their position, they are still underweight by long-term standards, which is why I continue to stand in. Don't get too cute. Don't get too bearish. Yes, we could have a 5 to 8% pullback. We may not get it because everyone's expecting it, but there's still, I think where I would gain more confidence of that coming, and probably not in the end of February because everyone's looking for it, but maybe after, maybe NVIDIA earnings will be less than perfect, and a lot of people are crowded into that. Who knows? But there will be some catalyst, and we'll get a short pullback and an opportunity to buy, and we'll make some money on our tactical short and use that to get long into year end. In addition to what we have in the meantime, dampening some short-term volatility. So on a normal 5 or 7% pullback, with some of the long-dated options, you might be down 10%. This would take out 5%, so you'd be down net 5 or 4, and then we'd have that additional capital to get excess alpha into year end. So it makes sense. And if we're wrong, it's 1% insurance, and we're still up. Outperform on the upside with the convexity of the portfolio anyway. So it's kind of a perfect risk-reward, responsible way to play it. Managers' sentiment and risk propensity, while improving, is not at or near an extreme. So everyone's saying they're the most bullish since 2022. Well, okay, but they're halfway up to an extreme. Same thing with growth expectations, same thing to amount of risk that they're taking in portfolios. And if you look at positioning, you can see they still hate emerging markets in China, they hate REITs, and they hate energy, which is why we like the Comstock story. We like the Crown Castle story. Vornado, we already flipped out last year for a double. You know, the bearishness is picking up in that group, so maybe we'll get another bite at the apple, but not in a rush there. I think there's a lot to play out. And then other important positioning trends. New early move from large cap to mid and small. We've been talking about this beginning of the year. The valuation arbitrage between 21 times and 14 or 15 times. Now you're starting to see that slowly begin. Same thing with small caps. And two, now that zero interest rate policy is in the rearview mirror, value is showing signs of a turn relative to growth. Small caps starting to show possible signs of life relative to large caps. So you can see here where zero interest rate policy began in 08-09. That was the end of value outperforming growth. And then in free money period from 2008, late 2008, early 2009 to 2022, when rates were basically zero, growth outperformed value. And now, since that's changed and the Fed raised rates, we're seeing a reversal on that front. And then similarly, we are seeing the same type of bottoming process on small caps relative to the S&P, which is large caps, that we saw in 2001, 2002, 2000 to 2002 period. We've seen in 21 to 23. And now it's showing signs of life. So we'll see if we get some follow through there as well. A reminder on seasonality. Everyone's looking at the same charts, which makes me a little skeptical. But, you know, they were also looking for a correction in August and September, and we got it. So sometimes the obvious thing happens, but right now, in terms of seasonality, we should get a little weakness in coming weeks, and we're positioned to take advantage. And if we don't get it, then we'll just have more upside in the overall portfolio because we're not taking off positions. We're just putting on tactical shorts with a very modest amount of capital. Generac. I try to highlight the results from 1 to 2 companies per week that we've talked about on our weekly podcast VideoCast. Today, we'll do a deep dive into Generac's results. So here was my original appearance with Liz in September on that name. Then we had the CEO, or one of my appearances. Then we had the CEO of Generac, was on CNBC last night. That's definitely worth listening to. We're not going to take the 7 minutes here, but listen to that on your own. But here are some of the key points. Net sales were up. Product sales increased. Net income beat 97 versus 71. Cash flow from operations was at a record $317 million as compared to $101 million the prior year. They repurchased 1.3 million shares for approximately $151 million. And they authorized another $500 million of buybacks. Guided for 2024 of 3 to 7% top line, which is nice to see because their C&I business is going to slow down, but their core bread and butter, the home standby generators, which has been, in the tank for the last 2 years because they overordered and everything with COVID, is now they've worked through the inventories and that's picking up like crazy. And we're going to see some of the metrics on that. Cash from operations was a record $500 million, or $522 million, as compared to $59 million in the prior year. Free cash flow, as defined by company reconciliation schedules, was $396 million as compared to negative $24 million for 2022. And the company repurchased about 2.2 million shares of common stock during 2023 for $252 million. Fourth quarter results demonstrate continued improvement in operating performance, resulting in strong margin expansion and cash flow generation as we exited the year. Said the CEO, despite fewer outages in the fourth quarter, home standby operator shipments returned to year-over-year growth, and activations reached a quarterly record. Global C&I product sales were approximately flat as compared to the prior year, with telecom and rental markets experiencing cyclical declines. Additionally, we generated record cash flow in the quarter, which allowed us to enhance shareholder value through continued share repurchases and investments to accelerate powering a smarter world enterprise strategy. Gross profit margin was 36.5% compared to 32.7% in the prior fourth quarter. That's huge, ladies and gentlemen. Cash flow from operations, $316 million compared to $109 million. Free cash flow, $266 compared to $80. So they're coming through here, and that's what this is. It's a recovery story, and we're starting to see that in spades. EBITDA was 21.6%, 192 up from 144, which was 16% of total sales. So all margins across the line are going up. Cash flow is going up. Sales are going up. And then the only variable is it going up too fast or too slow? The Barron's article said, they have growth, but it's too slow. So for the impatient, they can get out of the stock, and we'll just hang tight and get our double plus over the next 24 months while everyone gets in and gets out and misses the whole move. So return to net sales growth as compared to the prior year. Residential product sales growth in the mid-teens range, led by shipments of the home standby generators, et cetera, et cetera. Net income margin before deducting non-controlling interest to be 6.5 to 7.5. EBITDA margin expected to be 16.5 to 17.5, with free cash flow conversion from adjusted net income expected to be approximately 100%. So we expect in 2024, we expect to return to consolidated sales growth and year-over-year margin expansion for the full year period. And so on. Then on the conference call, generated record free cash flow, sales up, etc. No big weather events. When they get weather events, they get a lot of orders. So they had a record quarter even without the weather events, which was a big deal. They're talking about the cash flow. They're talking about slowdown of C&I, pickup of home standby residential. The other thing they said in the NERC, which is North American Electric Reliability Corporation, continued to warn that elevated risk of resource shortfalls across the majority of U.S. and Canada, as key forecasts around supply availability and future electricity peak demand are creating a higher risk of imbalance, leading to potential outages more so than any time in recent history. Significant opportunities for our portfolio of power resiliency and energy efficiency solutions well into the future. We believe a massive penetration opportunity still remains, as only 6.25% of the addressable market of single-family unattached homes greater than $150,000 in value in the U.S. had a home standby generator installed at the end of 2023. Furthermore, every 1% of incremental penetration worth approximately $3 billion of market value. And they have some states that are in the low double digits, even I think a couple in the mid-teens. So it goes to show on a countrywide, never mind the international basis, the runway they have ahead. And with market share greater than 70%, we believe Generac is incredibly well positioned to continue to lead the commercialization of this important product category. These same megatrends create significant opportunities for our global C&I products. However, in early 2024, this is the period not reported, severe winter storms pushed outage activity to record levels for the month of January. Power conservation notices sent to homeowners in select markets driven by unreasonably cold temperatures and the related spike in power demand also contributed to consumer awareness of the vulnerability of the grid. As a result of these factors, home consultations in January of this year were an all all-time record for the month. All-time record. Remember, ladies and gentlemen, this is a $100 stock. This was a $500 stock. So they are hitting on all cylinders in the turnaround. Now, it's not going to turn around in a week, but over the next couple of years, as we work back up, I mean, this is how you get multi-baggers, with patience, with a quality business, with management that's executing, cutting the costs in the turnaround, which is the same story for all of them, executing on all cylinders, and letting the cycle come back to them. That's the name of the game. So, here we are. So all-time high. Close rates improved moderately. More importantly, activations, which are a proxy for installations, were at an all-time quarterly record in the fourth quarter, increasing slightly from the previous record of the fourth quarter 2022, providing further support for our belief that the home standby category is holding a new and higher level baseline of demand, et cetera, et cetera. For 2024, we expect the home generator standby sales to increase at a rate approximately in line with the mid-teens residential sales growth guidance disclosed in our press release this morning. Additionally, we expect home standby generator sales to increase on a year-over-year basis in each quarter throughout the year. Sales of our residential energy technology products and solutions also increased during the fourth quarter as compared to the prior year, led by continued growth at Ecobee. They do smart thermostats, doorbell cameras, et cetera, et cetera, et cetera. You can read that on your own. EV charging solutions, they did a deal. C&I, they go into some detail. International sales. In closing this morning, we believe our fourth quarter results reflect a return to positive momentum in our overall business as our residential product sales began to grow again, which should help to offset cyclical softness in certain C&I customers and end markets. We believe we are nearing the end of the excess field inventory overhang, which was the basis of our thesis for home standby generators, and expect to realize strong year-over-year growth in shipments of these products in 2024. Our record cash flow performance in the fourth quarter is continued evidence of the earnings power of our business, and gives us flexibility to prioritize further organic investments, execute on strategic acquisitions, and opportunistically return capital to our shareholders. Okay. And then they talk about the destocking. I mean, and it's just normal cadence. So I would say the big excess field inventory level, that thing we've been talking about here for 6 quarters nonstop, we believe is going to be largely done at the end of Q1. So that's a big deal. Moving on to Comstock Resources with our new natural gas play reported earnings. We'll touch base on them in the podcast video because that's now. But earnings results are less useful for a company like this, which is simply a levered play on natural gas prices. The focus is, number one, are you paying significantly less than liquidation value, proved and unproved reserves, less liabilities? And two, do they have satisfactory cash flow and liquidity balance sheet to wait for the turn in price? Quarterly earnings noise doesn't solve for either of the answer. Here's a little hint in terms of natural gas seasonality. The price of natural gas tends to bottom in February and March every year. So by April, we should start to see the stock sniffing that out and starting to recover. And one client this morning actually asked me what I thought liquidation value was, or the value of proved reserves less debt. And I came in at about $35 a share. There's a lot that goes into that calculation. You have to have the right input of natural gas prices as well, not natural gas prices in the whole. But I think that's a conservative outlook. We believe they have the adequate runway, and we believe this is just getting started. So there's not a lot more to say about that one. That's not like a normal operating company. It's just basically operating leverage, low-cost producer on a product that's going to be in more and more demand as we move forward. Sentiment came off the boil a little bit on the AAII sentiment survey. Fear and greed is a little bit greedy. And then active investment managers are, let's see where they came in today, because that always comes in midday versus having the lagged stuff there. So yeah, 95.58. So not much change. They're chasing, which is why we have the tactical short on with EV of 5x. And if we do get that pullback, that can happen in 60 days, and we'll take it, and then we'll use that to get some excess alpha into year end as well. So pretty exciting stuff. All right. While we're recording, the earnings for Cooper Standard came in, and you have all your basement day trader morons selling 5 shares in the after hours. So it's down double digits in the after hours. Let's just look at the facts. I hope more of these idiots sell in the morning so we can get our newer clients a lot of stock at 10 or 12 bucks. I doubt we'll get that low, but we can only hope. But in the meantime, let's deal with the facts, because they'll do the conference call at 9 a.m. tomorrow. I think what's important is, what did they say they were going to do, and what did they actually do? So in last quarter, they basically took earnings guidance for 2023 up. Okay, so they took the baseline from 2.6 to 2.7 billion on the sales, EBITDA from 150 to 165 on the bottom line, and let's see what they actually did. So after raising guidance last quarter, what did they do? They crushed it. They did 2.82 billion, which was higher than the high end of their range. So they went from 2.6 on the bottom to 2.7 on the bottom, and they actually hit above the top end of the range at 2.8 billion. And these morons in their basement are selling off the stock, which you gotta love. Which is what this is why I love public markets so much more than private markets, because you don't get these pricing dislocations in the private markets. In the private markets, they look at you like, are you crazy? Why would I sell my business at a 16% discount when it's doing better than it was expected to do? That makes zero sense. Okay. So next, EBITDA, they took the bottom end from 150 to 165. What did they do? They actually beat with 167.1, well ahead of the bottom end of that. CapEx, all these expenses, they were in line, slightly better on a couple of them. But the key is the forward guidance. And my guess is that's what people are a little bit wanting to understand more with the call tomorrow, which is, if you did 2.82, why do you have such a low expectation in terms of light vehicle production in the US for North America, Europe? And if you recall, they had low estimates on, they had their estimates at 15.2 last year. They had to take them up to 15.6. They have them at 15.8 for this year. They'll probably have to take them up to 16.2 or 16.3. And then we start to knock on the door of where we need to be. But they're guiding to adjusted EBITDA of about 180 to 210, CapEx of 75 to 85, cash restructuring, net cash interest, and net cash taxes. The key thing here is, if you look at EBITDA and then reverse engineer to free cash flow, which, by the way, let's actually just go into what they actually did. Their sales were up 3.7% year on year. Their gross profit was up 19% year on year. Their net loss improved by 32 million from the previous year. Their adjusted EBITDA came in at 27.6, or 4.1 of total sales. And the net cash provided by operating activities was $80 million, improved by 105 million over the fourth quarter of 2022. So last year, their cash from operations was negative 105 million in the fourth quarter. This year, it was plus 80 million. And the pajama traders don't know what to do with themselves. I think it's because they made $2 in the last 3 days. They can't bear having an unrealized profit. Full year summary: total sales grew 11.5%. Gross profit totaled 280 million, which was 124% compared to 2022. Their net loss improved 13.4 million versus the previous year, and adjusted EBITDA of 167 million or 5.9% of sales, increased by 129 million over 2022. This is what a turnaround story looks like, ladies and gentlemen. And then the net cash provided by operating activities of 117 million, improved by 153 million, i.e., they went from cash flow negative to cash flow positive. And what's exciting is not just cash from operations. They, because of the fourth quarter ended so strongly, they generated $62.1 million of free cash flow, which brought them cash flow positive for the year at 36.5 million, which is what they promised to do, which was turn cash flow positive. And they didn't do it by 5 cents. They did it by $36 million, with 62 million coming in the fourth quarter. Oh, and by the way, there happened to be a strike going on during part of that. So a lot of stop and starts. And this, my friends, is the name of the game with turnarounds. All you're doing is solvency risk. Do they have the free cash flow? Do they have the runway for the overall secular trends or cyclical trends to come back? Whether you're talking about natural gas in the case of Comstock, or you're talking about auto parts, which is a highly cyclical business. And if you actually go back to our original thesis, which was $146 stock when they were doing about $400 million of EBITDA, and call it 200 million of free cash flow, the stock was $146. It's now whatever it is, $19 this morning, $16 this afternoon, hopefully $12 tomorrow morning. We want to get some more. I doubt it though. But so we're basically halfway there, but that's not the way it works. If you did 400 million in EBITDA and you got $146 stock, doing 200 million of EBITDA doesn't mean you get a $70 stock certainly right away, because the operating leverage is so pronounced that, and the convexity is when, once you get over a certain level, the impact on earnings and free cash flow becomes so material because your fixed costs are static, or in their case came down quite a bit through the pandemic. And then when you get over a certain threshold, which is why I think that even on 8 times 4, probably on 3.5 billion, not even, maybe 3.2 billion, they could do like $5 to $7 a share in earnings, and then you either have a 10 or 20 times multiple. So we've always thought if they could get to 85% of industry production, 85% of overall industry production than where we were in 2017 peak, when the stock was 146, with the amount of costs that they've taken out of the business, we could get that $5 to $7 to $8 or $9 a share in earnings. And then the question is, do we get assigned a trough multiple of 10 times, which means $50 to $80 stock, or a peak multiple like they had in 2018 of 20 times, which would imply a $100 to $200 stock. And we'll see. And I'm eager to see what they say on the call. But what this basically implies here in terms of where they are is, number one, the name of the game is they're free cash flow positive and meaningfully, so they have the runway. Then the question becomes, how long does it take for the industry production? Because if the industry production comes back, they're just going to mint money from their operating leverage. Does it take another year? Does it take another year and a half? Does it take another 2 years or 36 months? And the answer is no one knows. You can't really predict it. If past is any prologue, it probably takes a couple of years. And from a 5-10 original basis, if it takes us 5 years total to get a 20 bagger, do the math. That's a pretty good IRR. So we're patient. We like this free cash flow positive because that cements the runway. And all in all, better than expected on balance. I think what people would have liked to see is higher guidance, but these are Midwest operators, serious guys. I've met with them, and they are high quality operators, and they try to underpromise and overdeliver, and that's what they've been doing. And kudos to them. So I would expect as the year goes on, just like we saw in 2023, they're going to take this guidance up as the numbers come in better than expected, and that can accelerate our timeline for when we think this gets to fair and fully valued. So all in all, very pleased with that. As far as Comstock, I didn't expect we would be doing Cooper Centered on this call, but that came in mid-call, so we just cut it in. We covered really what we need to know about Comstock this week. As you can see here, commercials have been buying while everyone else is selling. I think we're probably similar situation like we saw in 2002, where you get this initial spike recovery and then you wash everyone out in 2001 and 2002. A lot of things are setting up like 2001 and 2002, whether it's China, emerging markets, small caps. Now natural gas is another example. And then it just has a secular run for 3 to 5 years as emerging markets rip, as the dollar weakens, and that's going to start to happen as the Fed starts to cut, which Goolsbee laid the case for. So it doesn't happen in March, then it happens in May. It doesn't happen in May, it happens in June. The key is it's going to happen. And if we have to wait, 2 more months or 1 more month or 0 more months, it really doesn't matter in the scheme of things. The key is you're on the right train, and we are. So moving right along, transport earnings, top 30 weights. In the last 60 days, earnings were revised down by 4.5%. Retail was revised up by 1.5%, so that's good. Overall, market earnings have been steady, if not going up. 75% of the S&P is reported. The earnings beat, by the way, is 2.9%. If you remember, estimates were only 1%, and we were saying secret to happiness is low expectations. Well, that's exactly what we had. And by the way, a lot of the drag, earnings could have been up 5% plus, was because of this new fee or fine from the FDIC on all the banks. That's why bank earnings were a little bit off, because they had to pay in all this money to the FDIC new insurance fund, which impacted earnings, albeit it was, it all hit in this quarter. But that's what impacted. Otherwise, we'd see earnings up 5% versus 1% expectations versus 2.9%. But all in all, earnings coming in better than expected, number one. And number two, you need to keep in mind that, earnings for this year are holding strong in this 243, 244, 245 range, and have actually started to tick back up in the recent weeks, being revised up. But the market, in coming months is going to start to look forward to 2024. And if you look at, 5,000 S&P divided by 275 versus 245, you're now looking at 18 times forward, which means if you back out the Magnificent Seven, you're probably at 14 and a half times forward. So a lot of stocks are cheap and a handful are very expensive. So that kind of gives you an idea of the trajectory. Basically flat earnings for 3 consecutive years, and now we're starting to reaccelerate in 2024, 2025, and beyond. Good stuff. Now, the podcast is over. We're going to move on to the Ask Me Anything questions. So, for those of you who want to stick around, we'll start with that now. Jacob Engel asks, what do you think of Match? We've covered Match a bunch of times. Recently, Elliott has gotten involved. The problem that we had with Match was just that the revenues were very flattish, but we do like their free cash flow generation, and we do like some of the attributes of the business. We just found that there were different things that we could do better. What's very interesting about this, and I know I've used the Koifin a lot, and I also use this other one, but it seems like people respond better to visuals. And in the case of Match, what you can see is similar to Alibaba. The price has been going down and the cash flows have been going up. Sooner or later, that reconciles. And how do we know that reconciles? Because you just see it over and over. Take a look at Google, for instance. Eventually, price catches up to cash flow. So during 2022, you saw Google, the cash flows went down, the stock went down, cash flows went back up, the stock went back up. Same thing with Meta was more pronounced. Okay, their cash flows eroded, and then they cut costs, and then the cash flows reaccelerated, and so did the stock. In the short term, the market's a voting machine. In the long term, it's a weighing machine. Same thing with Amazon, which we own from October 2022, when no one wanted it because they thought the cash flows were going to stay down forever. But did they? The answer is no. They were scary for a little while, but look, it came back, and so did the stock, and it's just getting started. So, for companies like Baba, where the cash flow has gone down and actually recovered, but the stock is not recovering with the cash flows. That'll eventually happen. And when it does, it happens all at once and it plays catch up very, very quickly. And Match is a similar situation. The issue I had with Match was that their revenues had been pretty darn flat for a very long period of time. And someone asked another question. You can see it here. Or was that? Let's see. Yeah. So I would just say that I'd be open-minded. The reason we passed the last time we looked at it is there were higher and better uses. I'm I like the fact that there's an activist in it now, and that may make things happen. Prior to that, you ran the risk of a value trap, and we had enough of these companies in the portfolio, whether it's Generac or others. The other one is, by the way, which we're not going to be able to see, but these are how you play turnarounds. Cooper Standard, same thing. Like Amazon, if you saw the cash flow went negative, and then when it starts to recover, the stock price recovers. Same thing, negative cash flows recover. The stock price goes to the moon when it went up to 146. Now we're free cash flow positive. So this next bar right here is going to be meaningfully positive. Right up, it's going to be up here, whatever that number was. What was that number? That number was plenty of cash and liquidity, which is also good to see. I didn't see that they. Free cash flow for the year was 36.5. For the quarter was 62.1. So this is going to show that they've just started to recover, and we see what happens the last time. And that happens with a lot of companies. Sometimes it happens a little right away. Sometimes it happens on a lag. But we want to see the stock price start to move up with the cash flows, and over the next few years, really start to accelerate and get back up into those triple-digit levels if they can hit on all cylinders, which we believe they can. So that's exciting. So yeah, Match I'm fine with. Enjoying your process. VideoCast. This is from Max Hughes. Very insightful, also very entertaining. I've learned so much and recommend it to anyone who also wants to learn more about investing and will continue to do so. Well, thank you for that, Max. If you can't afford to be a client and you want to give back, best way you can do is recommend this to one person you know who would benefit and enjoys markets and you think this can be helpful to. That's how it grows, and that's how we can keep offering it to non-clients as well as clients alike for free of charge. I have a question regarding PayPal. Being a PayPal investor myself, how is Wall Street viewing the stock as growth or value? I can imagine the latter because Wall Street primarily focuses in the case of new customer growth versus any other metric, and PayPal is deliberately shedding non-profitable customers. My concern is that no matter how well PayPal will do with profits, margins, they will never earn the multiples of growth stock and thus get reflected in the stock price. How would you, if there's such a thing, define such a value trap? Well, value trap is more likely to be a company that there are few things that would define a value trap. And it's very interesting because a very famous hedge fund manager came out and said the markets are broken because of passive investing and quantitative computers, and therefore value investing is over. And I looked at the portfolio of this fund and I saw that he had a lot of value traps. And what I would define as value traps are these sum of the parts where you wait for a catalyst that never comes, with flat or declining revenue, but trading at a low multiple, so negative growth, with no clear sign of a cyclical turnaround or a secular recovery. And when you have flat growth, flat top line, and flat cash flow, it limits the amount of stock that you can buy back. And in the case of PayPal, even if it's valued, obviously it has a value multiple right now, but with the $5 billion of free cash flow they generate, they can buy in a meaningful amount of stock every quarter and every year, which will ultimately cause earnings growth. And if Wall Street sees consistent earnings growth, then you'll start to get a multiple re-rating, and I think that's the story. So you'll go from a multiple, and that's part of our thesis, is you will get a multiple re-rating as they take the share count in, and as some of his new shock the world 5 initiatives start to kick in. And by the way, I'm a client of PayPal with the trade service, and they've been like emailing me every 3 days. Can we do this for you? Can we do that for you? Blah blah blah. You know, I don't have time to talk to them, but a lot of those things look attractive, and you know, it's just not a focus for me. But so it's a good question, but it doesn't apply to this company. You know, an example would be like a match if the revenue stayed at $3 billion every year, and we've covered a bunch of those companies where the revenues have just been flat for like 10 years. And the earnings. And so then you're never going to get a multiple expansion, and you are going to be stuck in a value trap. But that is not the case with PayPal or with Alibaba, even though they're trading at value multiples at present. They're reducing the amount of shares outstanding so that the EPS can go up. So you have earnings growth, which is going to lead to multiple re-rating, and then you actually get lucky and you get a tailwind with some of the initiatives starting to work, and you catch a tailwind of the economy in China, you catch a tailwind with PayPal with some of his new initiatives, and we're off to the races. Multiple re-rating, and it happens very, very quickly when it does. Roman Iva, thanks for all your hard work. What do you think about Yika 9923? Never heard of it, but let's take a look. Yeah, payment services in China. So this is if you followed me long enough, you will know that other than Alibaba and Tencent, there's no other company in China that I'll buy, because even though they look perfect on paper, half of them wind up being fraud. So I would just, well, half might be a strong word, but 9923. So I'll do it for fun and entertainment purposes, but I would never buy it, no matter how great it looks. So they're actually going the other way. They're actually turning cash flow negative. Revenues are going up. Yeah, this is not a business I want to be involved in, but so my guess, Roman, is you're pretty new, and so you haven't heard me repeat that over and over and over, number one. And number two, you're thinking it's cheap because the price went down, but it's cheap because the business is also deteriorating. So for that one, I'm a pass until things start to change. I'm a pass, period, because it's not Alibaba or Tencent in China. But Bob Johnson, would you mind adding some color on the VFC activist investor engaged capital and their backing from the VF founders to oust 2 board members? P.S. Bracken Darrell acquired $1 million of common shares. Sure helps the situation. So yeah, they're an activist investor. They run like, I don't know, but they got a new person on the board, which is this lady who ran, Carolyn Brown. She ran Donna Karan New York from 2015 to 2017, and led the company, sold it to LVMH and to G3 Apparel Corp. And then prior to that, she was the president of Carolina Herrera, a luxury fashion house owned by PUIG, international expansion. And then she was the chief executive officer of Acris, a Swiss-based luxury fashion brand. Her career began at Armani, et cetera, et cetera, et cetera. So it's just, activists are always good because they shake things up and they hold their feet to the fire. So we're fine with that. Rick Borax, thanks so much for the content and all the hard work you put into it. Greatly appreciate it. As it's been so motivational. How do I approach my own investing? So my question is this: What? By the way, thank you, Rick. I'm glad it's been helpful. Thank you for mentioning the kind words. I do put a lot of work into it, and I'm glad you're getting value. So my question is this: What do you do in a situation where you like a foreign stock, but it only trades with any volume in its home country? For example, I really like a Polish firm, Text SA, solid firm that's getting into bargain territory. Let's just take a quick look here. As a comparison, US OTC, LCHTF, 5 seconds to realize I can never get involved in that. I use an interactive broker but never traded a non-US market. That said, is it best to stick to the home base and negate foreign market political risk, or worth expanding out if you find something worth it? My gut says stay local. Is there plenty of options? Which should answer my own question, but I'm trying to challenge that to see if there's any reason I should. I think you think too much, Rick. There's enough to do at home and enough ADRs, and you can get the better quality international companies. But I'll take a quick look, and then we'll get back to business. TXT. And you got what is it, the Polish Zlotka or something? What's it called? Text SA. Margins are shrinking a little bit. Good balance sheet. I mean, for something like this, I might even consider buying it in Poland. Let's just do this in English. Yeah, so they're growing like a weed. Generating free cash. What type of business is this? Communication software, live chat tool, chatbot. All right, so you got to understand the tech and understand how their moat is durable. Balance sheet seems okay. Yeah, balance sheet seems fine. So I think with this, you just have currency risk. But if you believe that the dollar is going to weaken, as I do over time, you probably get two bites at the apple if the business keeps growing. But you got to understand the business just on the quantitative numbers. I think you found something really interesting. Maybe you can build a position. Let's see. LCHTF. LCHTF. I don't even think it'll come up on this now. So, but I think good work there, Rick. I think you might have something, especially if you have experience with Poland and can do some work on the company before you invest. Paul McCrory, analysis on where can I find your analysis on Google? They reported a couple of weeks ago, and in the article after that, we did that. Other than that, you can probably go back to the podcast in October and November 2022 when we bought it, and maybe a recap in March and find it there. Jack Cornez. Tom, to huge value from you. Thanks. You mentioned a tool back at the end of 2023 that you use for stock discovery. I don't really have anything for stock discovery. I mean, I use BinViz to look at all the stocks. So I just basically, if you do by large cap, 35 pages times 12. So you'll look at like 500 or 700 stocks pretty quickly. I like to look at them on a weekly or monthly basis and see what's up, what's down, why, and then you can do the same for mid cap and if you want to for small cap. But no, you just got to go through all of them. JP, hi turnaround Tom. What are your thoughts on TPIC as a turnaround play? They manufacture composite windmill blades as well as composite parts for automotive applications. Oaktree holds a large stake in this. Thanks again for the weekly video cast. Always a highlight of my week, JP. Okay, well, thank you. This is the week of kind words. Very grateful for that, ladies and gentlemen. So let's take a look at TPIC. Let's do an overview because people seem to do better with the visuals than the financials. Yeah, so this is consistently free cash flow negative. Revenues are holding in but flat. Negative return on capital, low margins. This is probably a pass for me. And my guess is Oakmark or Oak Tree? Oak Tree. My guess is they own the debt because they're expecting it to go bankrupt and they want to take the assets. So yeah, the price is down a lot, and I think the business is. Let's see. So revenues are starting to fall off. You can't really. Let's see if I can bring that in. Revenues. Nope, that's the balance sheet. Where's the income statement? Yeah, revenues have been pretty flat for the last few years. Negative free cash flow. Negative return on capital. Let's take a look at the balance sheet. They're pretty levered. So I don't know. These things are tough to predict. Whether windmills are going to be in popularity. I'd have to understand the business better, but just looking at the numbers, it would be an easy pass for me out of the gate. But I do appreciate you sending it over. And with that said, we're going to be back next week, same time, same place. In the meantime, make it a great one. Bye for now.